Well, as the US election approaches, what are some key areas to keep an eye on for investors? Will thematic ETFs offer a way to position portfolios strategically? Billy Long from Global X ETFs joining me up on the desk for more. Billy, in terms of what we're seeing with, I guess, demand here, how much of it is ramping up ahead of the election?
So I think it's interesting because look, just to be clear, I'm no expert in political science, but I think there's a few things we have to understand about this specific election before we sort of understand the potential outcomes of the thematics. I think the first thing to note is that there's actually a large, sizable, undecided amount of voters. So about 2 weeks ago, I think the statistics were showing that there's still about 16% of undecided voters, and I think right now it's closer to 10%, which means there's still potential for swing. Number two is that I think in terms of historical basis, about 2 months leading into the actual polling day, we still see about a 6% swing either way in front of two candidates or two parties. So again, there's a lot of uncertainty there. And I think there's two more points which is sort of more specific to this current election, is that the first one is for the Trump election specifically, the last two elections, his actual outcome compared to the actual vote on the last day actually changed dramatically. So on the last day, on the polling day, things could still change. And I think number four is, I think one thing that I think a lot of the market has been overlooking or misunderstood is that in terms of the US election, the popular vote does not equal the electoral vote. Okay, and I don't going to go into the whole US electoral college system, but I think to answer your question, I think the sort of outcome and the results from this, there's two key things we have to note for the equities market, and it's got to be doing with taxation, and number two, it's got to do with the tariffs.
Okay, what does it mean though in terms of, I guess, some of the tax implications here too?
Yeah, I think in terms of the tax, the US taxation is a little complex and a little tricky, mainly because it needs congressional approval, which means the president himself or herself can't decide alone. But just looking at it very simplistically, if we do see a Democratic presidential nominee winning, it will more likely be on the higher corporate tax rate. There's going to be higher social benefit spending, so there's going to be higher personal tax and consumption tax. And on the other hand, if there is a Republican win, there's likely going to be a less likely hike of a corporate tax. So going back to the scenario where there's a higher taxation system, what's being proposed is that the corporate tax is currently 21%, and what they're aiming for is to raise that to 28%, which I don't think is going to happen. More likely, in the middle of 25% if we do have that scenario. And what that means is that a lot of misconception is that higher tax is bad for tech stocks, which actually isn't always true. And what we've looked at in the historically is that it will impact stocks or impact companies which have a lower effective tax rate, because the lower it is, the more sensitive they are. And it's actually not unique to tech stocks. Actually, a lot of companies across all sectors generally have lower effective tax rate. And what we found is that generally smaller companies have lower effective tax rates, companies that are younger, less mature, and also I would say companies which are lower quality tends to have lower effective tax rate and more sensitive to higher corporate tax. So in that way, for a higher corporate tax scenario, I think for us, it's we prefer companies, I guess, which have higher cash flow, which have a higher balance sheet or stronger balance sheet, and generally have sort of higher effective tax rate. And a key to note is that if you look at the bigger tech companies like Amazon, Meta, and even Microsoft, they're actually paying an effective tax rate of about 19%, which is very close to the 21% corporate tax right now. So it's not true that it's impacting tax companies. It's actually more smaller companies.
Yeah. When we saw President Trump in power last time, and there is a lot of speculation that maybe we see Trump 2.0, it was during the COVID pandemic, but there was also a very cold relationship with China due to the tariffs. If we see that again, what are the implications here?
Yeah, that's a very good question. And I think, like you said, with the Trump administration, they've already been proposing that if there is a Trump administration, they will be imposing, I think, anywhere between 50 to 100% tariff on China. And I think that's going to be quite a step up in terms of expectations. I think current expectations is about 60%. But what I want to flag is that it's actually not just about China. If you look at the Republican administration, they're also proposing a universal tariff on every single country that's coming into US of about 10 to 20%. And they're also proposing auto-related tariffs for the EU and also South America as well. So it's not just about China, but actually they're increasing tariffs globally if there is a scenario of a Republican administration. So, for this scenario, I think, it's really important to look at companies, I guess, which are less globally focus and more domestic focus, and I guess sort of relies less on the global supply chain. These are the companies which I guess will be on the safer side in that kind of scenario.
Yeah. So how do you play all this, Billy? I mean, when you're looking at ETFs and the thematic play, and I guess trying to position yourself for either scenario.
Yeah, that's a good question. So what I like, but what's good about these scenarios is that it's either nothing happens or something happens.
Yeah.
So what that usually means is that we can try to tend to avoid the worst outcomes or the higher negative outcomes. So in that case, we try to avoid companies which will be impacted by higher tariffs. We avoid companies which could be impacted by high tax. And so having said that, we do like our global US infrastructure ETF, I think, which is something we've talked about before. And what we like about this infrastructure ETF, which has a ticker PAVE or PAVE-AU, is that it's focused on US infrastructure companies, and not just infrastructure companies, but also companies that are providing the equipment, the materials for the US infrastructure. So that's number one. Number two is that it's also supported by a lot of regulations and laws which are bipartisan support. So which means that either administration comes in, it's still going to be in place. What I'm referring to is the Infrastructure and Jobs Act, which is highly supportive of the infrastructure landscape in the US. And I think what's also important is that if you look at the Global Infrastructure ETF, all the companies there on average already have a very high effective tax rate of close to about 21%. So any incremental tax or incremental tariffs has very limited impact on the Global Infrastructure ETF.
Now, I ask you this all the time, but I am genuinely curious as well. What sort of a demand are you seeing broadly for ETFs, not only in the lead up to the election, but just given where interest rates are and with investors trying to, I guess, position differently?
Yeah. So definitely, I think in terms of demand, we are seeing actually, even stronger demand, in the recent times as well. And I think that's due to we're seeing a much more clearer picture in the US election, and also the interest rate trajectory path as well. I guess we are seeing more investors taking a higher risk or a risk on scenario. So, in terms of, actually seeing the flows, we are seeing very positive inflows, especially in the last month, and especially that August event. After that volatility event, we are seeing actually stronger flows.